Have you ever looked at a stock and wondered, has this stock gone up too far? Has it fallen too much? Is momentum getting stronger or weaker? Professional traders ask these questions every day, and one of the tools they use to help answer them is called RSI, the Relative Strength Index. Today you'll learn what RSI is, how it works, and most importantly, how professionals actually use it, because if you use RSI incorrectly, it can be dangerous. But if you understand its true purpose, it can become a valuable tool in your trading toolbox. Let's begin. Part 1. What is RSI? RSI stands for Relative Strength Index. It is a momentum indicator. Its purpose is simple. It helps measure the speed and strength of price movements. RSI moves between 0 and 100. Think of it as a thermometer. A thermometer doesn't tell you what will happen tomorrow. It tells you the current temperature. RSI works similarly. It doesn't predict the future. It helps measure current momentum. And that distinction is extremely important. Part 2. The most misunderstood RSI levels. Most beginners learn two numbers, 70 and 30. When RSI moves above 70, many traders call the market overbought. When RSI moves below 30, many traders call the market oversold. Sounds simple, but here's the problem. Many beginners think overbought means sell, and oversold means buy. This mistake costs people money every year. A strong stock can remain overbought for a long time. A weak stock can remain oversold for a long time. RSI is not a buy button. RSI is not a sell button. It is a momentum gauge, nothing more, nothing less. Part 3. Understanding momentum. Imagine a runner sprinting down a track. Momentum is not just about position, it is about speed. Markets behave similarly. Two stocks may be rising, but one may be rising with much stronger momentum. RSI helps reveal that difference. When RSI rises, momentum is generally strengthening. When RSI falls, momentum may be weakening. Professional traders pay attention to these changes because momentum often influences future price behavior, not perfectly, but significantly. Part 4. Why strong stocks often stay strong. One of the biggest surprises for beginners is this. Strong stocks often stay strong. Weak stocks often stay weak. A stock reaching an RSI above 70 doesn't automatically mean it will collapse. Sometimes it means institutions are aggressively buying. Sometimes it means demand is overwhelming supply. Sometimes it means momentum is exceptionally strong. This is why professional traders do not panic when RSI reaches high levels. Instead, they study the broader context. Trend, volume, support, resistance, and market structure. RSI becomes one piece of evidence, not the entire decision. Part 5. The power of RSI divergence. Now we arrive at one of the most powerful RSI concepts, divergence. Imagine a stock continues making new highs. Everything appears strong, but RSI starts making lower highs. Momentum is no longer keeping pace with price. This creates a warning sign, not a prediction, a warning. The opposite can also happen. Price makes lower lows, but RSI makes higher lows. This may suggest selling pressure is weakening. Again, divergence is not magic, but it often alerts traders to potential changes beneath the surface. And professional traders pay close attention to changes in momentum. Part 6. How professionals use RSI. Professional traders rarely use RSI by itself. Instead, they combine it with other tools. Trend analysis, volume analysis, support and resistance, moving averages, risk management. Think about a courtroom. A lawyer doesn't rely on one piece of evidence, they gather multiple pieces, then they build a case. Professional trading works the same way. RSI contributes evidence, but it should never be the entire argument. Part 7. The biggest RSI mistake. The biggest RSI mistake is treating it like a crystal ball. Many traders see RSI above 70, they immediately sell. Many traders see RSI below 30, they immediately buy. Markets are not that simple. Indicators do not remove the need for thinking. The market rewards analysis, not shortcuts. Use RSI as a tool, not as a substitute for judgment. Part 8. The professional mindset. Professional traders understand a powerful truth. No indicator predicts the future. Not RSI, not moving averages, not volume, not anything else. The goal is not certainty, the goal is improving probabilities. RSI helps measure momentum, and momentum is one of the most important forces in financial markets. When combined with other evidence, RSI becomes far more valuable. Homework challenge. Open 5 stock charts. Add RSI. Observe stocks above 70, stocks below 30. Examples of divergence. Examples of strong momentum. Do not trade. Observe, study, learn. Train your eyes to understand momentum. Today you learned one of the world's most popular indicators, RSI. You learned what it measures, what it does not measure, and how professional traders actually use it. Tomorrow we will study another powerful momentum tool, MACD, a tool used to identify trend strength, momentum shifts, and potential changes in market direction. Subscribe to Wealth Entertainment 21. Turn on notifications. And remember, indicators don't predict the future. They help you understand the present. And understanding the present is one of the most powerful advantages an investor can have. I'll see you in episode 11.